Awesome. So, everyone, thank you so much for joining us on this beautiful Thursday afternoon for this wonderful webinar that I'm hoping you guys get a lot of insights and a lot of knowledge from. So, for those of you who are joining us for the first time, my name is Tomi Salami, and I'm one of the co-founders of FEM, which stands for Female Earning More. And myself and Nadia, the other co-founder, really had a passion for making sure women bridge that gap in their financial knowledge and their financial literacy and become really, really intentional about growing their wealth and growing their net worth. So we hope this we hope you guys really enjoy the session, and we have a few more to come because we have these webinars once a month. And like I was telling Chris, we just recently launched a newsletter that goes out every 2 weeks. So definitely keep an eye out for that as well. So without further ado, I'm going to intro Chris here. Um, he is someone we met a couple of months ago, and we were blown away by his passion for helping people with their finances. Just to give you a little background on Chris, he actually has over 21 years of experience helping people make smarter money decisions. And really, he's all about being strategic about using the resources they already have to build their wealth faster. And if you ask him, he'll tell you that he's very passionate about, and he's actually a little obsessed with maximizing his clients' wealth. So, Chris, I'll hand it over to you.
Perfect. Well, thank you so much, Tomi, and thank you and Nadia and the organizers for inviting me to be, able to share some information with your community today. I'm very excited by it. It was great when I met both of you, just to see people who have so much passion for education and growth and earning more money. I think that, the more people earn, the more power they have and the more direction they can take with their lives. And it's all about education. I have the privilege of working with a lot of people who are doing very well these days, and a lot of them haven't figured out a lot of this stuff. So I'm going to give you some of my best ideas. This is the kind of stuff that people come in and they've got massive portfolios, and a lot of them are a bit older. They're doing very well, and these are the basics that a lot of them haven't mastered yet. So hopefully you and the FEM community can take some of these ideas and integrate them into your life, at whatever stage you're at, and benefit from them. So from there, I'm just going to jump into it. If people have questions along the way, please feel free to ask. This is a pretty informal, way of doing things. So I'm more than happy to try to answer questions as much as possible. But just a little bit more about me. Thank you for that good introduction, Tomi. A lot of the people that I find to be great clients that I have a good relationship with are somewhat entrepreneurial, right? Some of them are employees, but I work with a lot of business owners and people who are, self-employed professionals. So you've got people in medicine, lawyers, those are some of the primary ones, architects, that type of people who often don't have a pension themselves because they don't work for a larger company, but they make a fair bit of money. They're in a high tax bracket, that type of thing. So most of them are too busy to stay on top of this stuff. It's kind of like keeping a really nice garden all the time. They just want to say, look, can you just do this, make it automatic, and make it happen for us? That's a picture of my son and I. We were up at Family Cottage recently, and really family for a lot of people is the reason that they want to do all this stuff. It's so that they can spend time with their loved ones. And he's a little guy that over this whole crisis, I've had the chance to spend a heck of a lot of time with him. Our daycare was closed for about 3.5 months. So him and I have bonded a lot. It's been kind of crazy at times, but a lot of fun as well. So his name's Jack, and he's about 2.5, and he's a very wild little guy. So anyways, that's a little bit about me, kind of where I'm coming from. I spent a big chunk of my career on Bay Street in Toronto, working with stock analysis and with institutional asset managers, kind of helping to explain to our clients who were pension plans and large clients like that what they should be invested in and how different investments will impact their ultimate beneficiaries. And then a few years ago, after talking with a lot of business owners and people in my life about what they were doing themselves, I realized there was a need here to really get some good info and help people figure out their own lives, because I thought there was a huge gap there. And the reason that the presentation that Tomi and Nadia initially came to was about wealth and women, and this is sort of another theme that I'll be talking about today. What I found is that some of my absolute best clients are women. I think that there's also a bit of a knowledge gap there, just because if you rewind back about 100, 200 years ago, the amount of money that women are earning has just exploded over the last several decades and generations. But there's not always that continuity where you'll have a grandmother teaching a granddaughter about money, because they just may not have known about those things. Whereas you do find more grandfathers spreading some of that knowledge. So I think everyone's exposed to the same tax system. Money doesn't know if you're young or old, if you understand it or not. So you may as well get the education out there. So gonna have my quick little disclaimer up here, just saying that I'm gonna throw out a lot of ideas because I don't want to hold anything back. But make sure if you think something like is a good idea for you to use in your own life, that you really talk to somebody that understands your situation, a qualified tax person or a legal person or a financial professional, someone like me, and make sure that they think it makes sense as well before you go and do anything. There, I said it. So these are there are three big issues that are unique to women and wealth, and that's one of the topics I'm going to talk about. That's the first one that I'll cover. You've also got number two, females earning more. Females are going to pay more taxes. So that's another one that I want to talk about, because I found that taxes are one of the biggest issues for men and women out there. Just misconceptions about how taxes work in the Canadian tax system. We've just gone through one of the biggest, most jarring sort of series of months in generations in the stock market. So I wanted to leave you with a couple tips for investing through a pandemic, because we're not through it yet, I don't think. And even if we are, a lot of people are shaken up at this point. So I've got a bit of perspective I wanted to share. Number four is a quick overview of what I'm calling when life has other plans. And I'm just going to touch on a little bit about different ways that insurance works, just because when I talk to people, when we used to go to parties and, when I hang out with friends, everybody's interested in stocks. And a lot of people are trading their own stock, whether it's, a new tech company or some sort of a new medical company or something like that. But you don't hear about many people doing cool things with insurance. And what I find is that most of the time, most people don't even understand how it works. So I'm not going to go too deep into that, but I'm going to give a quick lay of the land and just sort of show you, these are the big rocks that we look at when it comes to insurance. And then also just, this is a very quick one, just looking into the future, how I wrap some of this together and looking at a little bit of a case, very quick one. So I alluded to this a little bit, just that the economic power of Canadian women is increasing dramatically. And here are some cool stats that I got from one of my colleagues. So by 2026, women will control about half of the financial wealth in the country. The total annual income of women in Canada will be about $500 billion. They'll grow their financial assets by about 70% in the coming decade. They've accounted for more than half of job growth, and more than half women are the primary earners in their households. So basically, if someone isn't looking very carefully at making sure that women are comfortable with their wealth, they're kind of missing half the market, and they're missing the fastest growing part of the market. I think it's just a huge opportunity for every part of the financial services industry to make sure that they're catering to women, because they're some of the best clients, and in the near future, they will be a really rapid growth area. So talking about the wealth issues that are unique to women, the first really important one is longevity. And if you look at Statistics Canada, what they'll show you is that on average, women live longer than men. So back in 1970, the average man could expect to live to about 69 years old, and a woman born at the same time could expect to live to about 76. If you fast forward to last year, the average Canadian can expect to live longer, about 79 for men and 83 for women. So just in that about 50-year period, you can see that men have increased their lifespan by about a decade, and it hasn't been quite as much for women, but they still have a substantial lead over men. So that's great. No one wants to not live for a long time for the most part, but that also creates some very important issues when you look at planning. And with that longer lifespan that women typically have, It means that they need to fund a longer retirement, because you don't hear most women saying, I'm going to live 5 to 10 years longer than the average man, but I'm also going to work 5 to 10 years longer than the average man, right? Like that's not something that you typically see. Another key thing is being able to protect their savings from inflation for a longer period of time, and potentially paying more for ongoing healthcare. I'm not sure if any of you have grandparents that you've seen kind of get older progressively and move into some sort of a place where they receive care. I've seen that with a few of my grandparents. I've seen it with some clients and some clients' parents, and it gets incredibly expensive, right? That final little phase of life. So making sure that people are prepared for that from the get-go. It's not really the sexiest topic, but it's incredibly important. So the next one, this is something that makes some people's blood boil, and that is the wage gaps that are out there. So there are a few different types of wage gaps. That's why I have the plural there. So women tend to leave the workforce more than men. They take periods out of it. On average, the stats say that they earn less. And as a result of all those factors, they typically have lower pensions as well. So it's like there's nothing good or redeeming about this. It all just kind of sucks, unfortunately. So during 2018, for every dollar that was earned by a male worker, a female worker earned 87 cents. That's from a Stats Canada report. Now, women who leave and re-enter the workforce in order to help out with family can often lose seniority, right? Everyone's kind of on this ladder, and you have your network of people immediately around you. And then if you duck out for a couple years, right, whether it's to help an aging parent or a sibling, or maybe you're starting a family, you come back into the workforce and people had a little bit of time to get ahead, and it's really hard to bridge that gap. So it's not fair. It's just something that seems to happen out there, and I think being aware of it is incredibly important. I hope that we come up with actually better solutions over time to address it, because it's not fair at all. But as a result of that, women often have to rely more on themselves to fund their retirements, and they're also going to rely on more government supplements. So, men have it good in a lot of ways when it comes to that side of things. Now, when you look at the stats here, you can see that back in 1999, 2000, about 20 years ago, that wage gap was almost 20%, which is astonishing. And these are Canadian employees between the ages of 25 and 54. And this is Statistics Canada saying that this is what it was. So I'm sure there are some imperfections, but this is a big thing that is pretty well known out there. So thankfully, over the past 2 decades, this has closed a fair bit, not quite half of how bad it was. And it seems like it's continuing to close. When you think about, any new large tech company, like I'm part of RBC, which is a huge financial organization, there's no shot, as far as I can tell, anywhere that, your sex or anything else determines how much you're going to get paid. It's all about the value that you're able to bring the organization. It's about your education, those types of things. So thankfully, sex is being removed as a factor, a discriminating factor in how much people are paid. So, but since it's something that has been there, I just want to show you, from my perspective, how dramatic the impact of this can be over time. So I just made up a couple of people, Judy and Andrew. This is Judy. She doesn't look very happy because we're talking about how she's not getting paid as much for doing the same work as her colleague, Andrew. So we'll just take a look at this. She's earning $80,000. Because of that wage gap, he's getting, I put here, 12.5% more. So he's bringing home $90,000 a year pre-tax. And pay attention to these numbers, because I think it'll surprise you. I was a bit surprised when I ran them even. So I did a rough calculation on the taxes. I think Judy will probably have to pay just over $20,000 a year in taxes. Andrew's going to have to pay more taxes, obviously, because he's making a big chunk of money more. So their after-tax income is here. Judy's just under $60,000. Andrew's at about $66,000. So what does that mean? That means $6,861 of after-tax money every year. That's the difference between these two. Now, that's a couple nice vacations or a lot of good meals out in pre-COVID times at least, or it's a big chunk of money, however you slice it. But the real impact happens when you look forward into the future and you say, okay, if this compounds and this keeps happening year after year after year. So I ran the math and I want to show you how it looks. So let's say that everything was static and they just they kept their same wages forever, and between the ages of 30 and 60, to make the numbers really simple. And Andrew just took that money that he was getting that was extra above and beyond what Judy was getting, and he said, you know what, I'm going to throw this money every year into a tax-free savings account, and I'm just going to let it grow. And I'm going to put it in risky enough investments because I've got a long time horizon. And it turns out it grew on average 7% a year. All right, so I think I'm not trying to make any assumptions too crazy here. I think that this is pretty within the realm of reason. You could argue it different ways. But you have that money in there for 30 years, compounding at 7% every year. You put that extra amount on. And how does that look after 30 years? Well, you can see right here, that little difference compounded over time at the end of 30 years becomes worth $700,000. So that's kind of insane when you think about that, So when people say, oh, well, it's not that big of a deal, it might not be in any particular year, but when you really start to stretch it out over time, it becomes absolutely massive. So this is something that, women need to be aware of, that wage gap is out there, and it's been making things harder for women. I think younger women probably will have less of an impact on their lives just because that wage gap has been increasing. But think about someone who was in their peak earning years in 2005, earning 20% less than a male counterpart, right? Their portfolio is lower. And I see that sometimes when I look at client portfolios, right? I look at the portfolios that guys have, that women have. Now it depends on a lot of other factors like the savings rate and the type of career somebody's in and all kinds of other stuff. But the real thing there. So I think that this puts even more pressure and, raises the importance of women learning about doing everything they can to better their financial situation. So this is the third big factor. And I got a picture of a sandwich there because I call it getting sandwiched. And it's women falling into the sandwich generation more than men. It's just this idea that we see over and over and over that women are more likely to take care of aging family members and caring for children than the males in their family. So, it's not like that with every family. You can find tons of examples where the reverse is true, but on average as a society, this seems to be a big trend that's out there. So it puts pressure on women's finances. They may help fund their parents' finances more. They may help with their children's future more. And even if, there is a man in their life who's funneling a lot of money into things, the women are still putting their time, which, there's that opportunity cost to that because women are earning the same amount as men or close, depending on how the wage gap is impacting things. So, there's that opportunity cost if they're out of the workforce helping people out. So those are three big challenges. But I think, being aware of them is huge. I think movements like FEM will probably be able to hopefully teach you how to make more money, because I think that if you have two people starting off, like you have two people like Judy and Andrew in my example, and they're both 25 and they're earning that amount of money, if Andrew just coasts through being smart and savvy and working hard and networking and things like that, Judy should be able to blow past them over a few years in terms of salary. So you have a lot of control over this, as long as you don't stay stagnant yourself. So I'm going to touch a little bit on taxes now, just because for most people, they're the single biggest expense over their lifetime. And that's kind of shocking. You think about, blowing money on, whether it's going out for dinners, you get a good experience there, or trips, or even a house. If you really look at your lifetime earnings, for most people, a huge chunk of that is taxes. And a lot of people think, well, I don't really have any control over that. The government tells me what I have to pay. Well, that's true to some degree. But what I find is that the wealthier people get, the more time and effort and resources they put into being strategic and planning to, they always have to follow the rules. But there's a big gray area with the rules where you can do certain things and legally pay less tax. So I just think that it's very much worth it for everyone to understand the tax system and how it works, or at the very least, if you don't feel like understanding it yourself, work with people who do understand it, whether it's financial professionals, people like me, having a good accountant, things like that. And it's not like you have to go out and do all this right away. It's sort of things over your life to start bringing in. I put a lightning bolt there because there's some high voltage power there with taxes. So, like I said in the intro, if you're earning more, you're going to pay more tax. And taxes really are a key to unlocking the right answers for a lot of different questions. These are questions that I get all the time. So people ask, what should I do? Should I put my money into an RRSP or a TFSA? And I think, Jamil, you said you're in the US, so you're going to have different stuff down there. You're going to have, 401ks and Roth IRAs and stuff like that. But I think some of these concepts should be pretty similar. So hopefully it's useful there. And trust me, like, this stuff is on the internet. These are not secrets. But hopefully what I'm doing to add value is to try to weave it all together in one short, concise little package. So you kind of say, okay, I have an idea about how this stuff all fits together. But being strategic with your RSP versus your TFSA. And just as an example there, if you've got a big chunk of money and your income is almost nothing for a year because you got laid off from COVID or something like that, it may not make a whole lot of sense to put money into your RRSP, because the whole point of doing that, which you'll see on an upcoming slide, is to take advantage of tax savings that the government allows you to take. Another one, where should my home down payment come from? People are always asking that. And some people say, well, I'm gonna take it out of my checking account. Some people say I'm gonna take it out of my TFSA. There's something else that a lot of people are aware of, which is taking it out of your retirement savings account. You can do something called a home buyer's withdrawal, and you have to put the money back in, but you can take it out without any penalties for several years. So you can be very strategic with that. Sometimes you may want to put money, take it out of the TFSA and do top ups, and the point that I want to drive home here is that there are a lot of ways to do some of these things. And, having knowledge about how taxes work will really change your thinking. And usually there's one answer for this stuff that makes a lot more sense than any other way. This one, get a lot. Should I pay down my mortgage, or should I use the money to save for my retirement? Right? Again, when you understand how all the taxes work, then the taxes and the investments and the growth, you can run the numbers. It's not the same for everybody, but you can usually find something that makes the most sense for your situation, at least mathematically. This is something, should I incorporate? I don't know if there are any business owners or professionals that can incorporate on the call, but like a young optometrist sometimes will ask me this, or somebody that's in some other healthcare field. A lot of business owners ask this, and this is another thing that the taxes have a huge impact on there. It can really change the direction that you go. Something like that. This is something that I do spend a lot of time on with clients. It's a rabbit hole that you can go into, so I'm not going to go further into it right now. But again, it's another important way to understand taxes. How do I handle an inheritance? This is another thing where taxes really change the dynamics for families a lot of times. I've spoken with a couple families just this week who have these huge tax liabilities. So basically, there's somebody very old, a grandparent, who's got all this stuff. It's a combination of real estate. They may have some investment portfolios. They may have a business. And really, if they don't have the handle on their taxes, which unfortunately some of them don't, when somebody passes away, they're going to have this huge tax bill. And a lot of people don't really know how to deal with that. So as younger people who will probably be the beneficiaries of some inheritance at some point, taxes are another important thing to know there. And then when it comes to estate planning for yourself, eventually, hopefully not for a very long time, understanding what the key considerations are. So there, I said it. That I think taxes are important. I just want to show you this because I can't tell you how many multiple six-figure people I've shown this table to who are like, oh, I didn't realize it looked like that. So what this shows is Canada's graduated tax system. And what it basically means, if you look at the right-hand side, and this is all for Ontario, it shows your income. So there's a column that says taxable income. And is it big enough for you guys to see? I can see your face now. Yeah, I see nodding. Okay, good. So basically, I'm just going to walk through the first line to explain everything, and then you can just see, and I'll talk a little bit more about the rest of the table. But someone that earns $10,000, the second column, they don't pay any tax, so their average tax rate is 0. Other income is income like a salary income. So if you work at a job and you get a salary, that's the tax rate that will be applicable to your salary income. The other ones are more if you're investing. So if you have investments in the stock market or in a private corporation, those are where the dividend tax rates will come into play. And then there's the capital gains tax. So that's if you're buying stocks and it goes up and you sell it and you have a gain, or if you buy an investment property or a business. But I've circled the other income salary column just because that's what I want to show you. So at $10,000 on the extra dollar that you earn, you pay no tax. But then pretty quickly, when you go up to $60,000, $70,000, you're paying almost 30% tax on that money. And then you can see if you're in the fortunate position to earn 300,000 plus, you're paying more than 50%. And that's the way things are right now. Now, if you look at what's going on in the world right now, every government has taken out massive, like insanely large amounts of money to stimulate the economies and keep everything floating. And a government is kind of like a big business in a lot of ways. And not exactly, but there are some similarities. They need to get money from somewhere. And where they get a lot of their money from is taxes. So I think that there's a potential that they may look at changing some tax rates. And by changing, I mean increasing some tax rates in the future. So I think this will become even more important to really understand how all this stuff fits together. So that's almost all I wanted to say about taxes, but just to really hammer home the importance of getting clear on taxes and the huge impact that can have.
Chris,
so
yeah, I just wanted to ask a really quick question, and I'm not sure if anyone else has that. So if on that tax table, if I earn, I'm assuming they're going to use like that or their income. If I earn 70,000 total, so from salary, from business, from dividends, blah, 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 they would use one of these, or would they use different tax rates for the different income I'm earning?
So they'll kind of like, you'll have to, see with an accountant exactly how it's going to be for you. But typically what they would do is, they'd use some combination of them. Okay. So the highest tax rate will be a total of all the different income that you have together, but there will be some sort of a blended rate depending on the sources that you got the income from.
Gotcha. Okay.
But yeah, that's a really good question. Like one thing that I think is very, very cool that I haven't been able to help anyone implement yet, but I'm going to eventually, is if you look at the taxable income at $40,000 and you go across to the eligible dividend column, you can see the tax rate on $40,000 of eligible dividends 0%, which I think is super cool. So that means if you were in the fortunate position to be able to buy enough stock of Canadian companies like RBC and other dividend paying companies, that your dividends every year were $40,000, you probably need about $1 million to do that. 0 taxes, which is pretty sweet.
Okay, thanks.
So yeah, you're welcome. I hope that was somewhat helpful. So yeah, this is a cool table to really understand, and it helps answer all those questions about should I put this here or there. So this is just a quick touching on RRSPs versus TFSAs, because so many people find this kind of confusing. I don't think this is not the definitive guide to them at all, but basically an RRSP means you earn some money, you stick it in your RRSP, you don't pay any tax on it today. You're going to pay the tax later on in the future when you end up taking the money out of the RRSP. And for a lot of people, that's retirement, but it could be at any point. If someone got laid off or something because of COVID this year, they could take money out of their RRSP, and it could be an opportune time to do it, just because their tax rate may be very low if they don't have a huge income this year. So the way I look at it, this is an unofficial way of explaining it, but it's kind of a bet that you'll be in a lower tax bracket when you take the money out than you are right now when you put the money in. That's kind of the idea there. You're trying to play tax rate arbitrage. And then a TFSA is a tax-free savings account, and that's a Canadian thing that's been around for well over a decade. In total, they keep growing the amount that you can put in every year, or they have at least. I don't know if that will continue indefinitely, especially with everything that's going on. But right now, someone could, if they had never used it before, they could open one up and they could probably put in just under $70,000. And that money, the government says they won't touch it ever. You can take it out and the cash is yours. It could grow to $1 million, as long as you don't, there's a few things you can't do, but for the most part, you're fine doing anything. And I think they're a really good opportunity. I think everyone should probably have one and max it out depending on their situation. So you use after-tax money to fund it, and then you don't pay any tax later. And these accounts, they're both considered registered investment accounts, and they shield the investments from the taxes while the money is in the accounts. So if my example earlier talking about money compounding at 7%, if you had that in your own personal account that wasn't sheltered from taxes, in theory, the government would be able to grab a little tax bite out of that every year if you were getting dividends or interest or something like that. But a tax-free savings account and an RRSP, it's a protected vehicle that lets the money just keep growing and growing inside of it. Okay, so here I'm just going to I'm going to switch gears and talk a bit more about, sorry, my mouse is doing something weird, just about investing during a pandemic. And this is a chart from the people over at RBC Global Asset Management, some partners that I do a lot of work with. I think that this is great. This isn't super long term, but this is about a 20-year chart. And the main point here is that there's always going to be something. Now, thankfully, it's not always something as big as COVID, but if you just look back over the past couple decades, right around 2000, we had this huge tech bubble bursting. And it looks like a pretty small mountain right now, but back then it was absolutely massive. Someone could have put in $10,000 in the year 2000, felt euphoric as it went up to $13,000, $14,000, and then it came crashing down to maybe $7,000 or $8,000. So the percentage changes were absolutely massive. Then we got hit with 9/11. Then there was a war in Iraq. If you go forward to 2007, the housing bubble burst, the global financial crisis. So all I'm trying to say is there's always going to be something that's causing humanity to worry about everything. If you look at some longer term charts, I don't have one in this presentation, but if you're really curious, I do have some of them. You can go back hundreds of years, and it's just been this constant boom and bust cycle of things. It's just kind of how humans and economies are wired to function. And I expect they're just going to keep going like this. It might even get crazier, just the way a lot of technology is evolving and the way globalization's worked. So I think it's very important to keep a long-term focus. It can be very hard to do. And this next slide talks about the emotional roller coaster that people go through. They start off with this optimism, and it goes to excitement and thrill as things are going really well. You feel that euphoria, then boom, something happens. This virus in Wuhan, China starts to pop up a little bit, and everyone thinks, oh, they'll be able to take care of it. And then boom, it just turns into this raging global fire. There's anxiety, delirium, fear, desperation, panic, despondency. And that's the bottom, the trough, when people say, you know what, I just can't take this anymore. I can't handle the risk. I want to sell. I don't want to be part of this anymore. So some people do. Some people always get kind of shaken out of the market. Sorry, I forgot to turn my phone on silent. 1 second. But then at that very bottom, it seems like humanity is able to turn a corner, and there's light again, and we can breathe again. And hey, maybe we're not all doomed after all. And it goes from despondency to depression, and then there's a bit of hope and release and optimism, and then the whole thing just starts and goes again. So that's kind of the emotional roller coaster. And if you're someone who gets into investing, or if you're already someone who's an investor, you may be on that. And again, just recognizing that that's what's happening and that's what's going to continue happening, I think is a huge relief, because you just have to say, I'm going to release my attachment to things, to being able to control things. I'm going to put some faith in the numbers and have some trust that it will work out. So speaking of things working out, if you look at a longer time frame, this is one of my favorite charts, because this is something that I think I have to believe in to be in the business that I'm in, of taking these risks and investing money. But what this shows is it shows the range of returns, these blue bars, and that's the range of returns for a portfolio, a balanced portfolio with some stocks and some bonds and a little bit of cash. And it shows that in any 1 year, on average, you'll get an outcome, or the return for the year will be somewhere between -16 and 29%. So we're not talking about GICs where, it's like, here's your 1% or your 2%, it's not going to move. These things will fluctuate, and you have to have some comfort with those fluctuations in order to play this game. But then if you can stick with it and hold on to that roller coaster for 3 years, that range of outcomes shrinks. And you can see it shrinks and it goes up a little bit. So there, you're more likely to come out either 19% ahead or 5% behind. So you think, okay, the odds are starting to tilt in my favor a bit. If you can hold on for 5 years, it's unlikely that you're going to go below 0%, and you'll probably be between 0 and 16%. You go 10 years, you're probably going to be minimum 2% up to 14%. So you can see it's compressing on the top and the bottom. If you hold a portfolio like this for 20 years, historically, you've been somewhere between the 5 and 8%. And if you are able to hold on for 30 years, typically you're somewhere right in between that 7 and 8%. So what you can see is that this is an absolutely terrible gamble if you're only in it for a year. And it's one of the best things in the world if you can hold on for 20 or 30 years. So when you think about where you are in your life and when you'll need retirement money, for some of you, it's going to be 20 or 30 years away. And, you could probably do much worse than taking a gamble like this, even though I don't really think it's fully a gamble, but, there's an element of risk without a doubt. So that's just showing here that red line that came in, that, nothing's guaranteed in this world, but if you look at history and you look at the future, a lot of people who have experience and have studied this think that there's a pretty small chance that you're gonna lose money if you stick in this for a long time, especially over that 10+ year horizon. It's pretty hard to lose out. So one other question I get a lot is, hey, should we sell everything now because it feels expensive and then we'll buy it back at a lower price? Or should we buy now and then sell when it goes up a little bit? And my philosophy is that it's incredibly hard to time the market consistently. I think people can do it for a little while sometimes, but over the years and over the decades, people have different kinds of events. They'll go on vacation sometimes. They'll have very stressful periods of work. They'll have crazy stuff happening with their family, and being right all the time is incredibly hard. But thankfully, you don't have to be right all the time. If you can just stay invested and kind of take a little bit of a set it and forget it approach, that will do extremely well for most people. If you see here, this is saying that if you missed the 10 best days in the market over the past 10 years, this is how much it would have reduced returns. So if you just stayed invested, didn't do anything, didn't even look at it, you'd be up 6.9%. If you missed those 10 best days over 10 years, it would take your compound return from 6.9 to 3.83. So it's almost cutting it in half just by 10 magical days. And you've probably seen, if you've been watching the stock market this year, we've had crazy days where you're going to get 3, 4, 5, 6, 7% in one day. And if you're trying to jump in and out and you miss that day, then it may not come again for a very long time. If you miss the 30 best trading days, you're actually going to be down. And then if you miss the 50 best trading days, you'll be down about 4%. So, the market is kind of ruthless. I would never deny that, but if you know how to harness its energy, then I think you can do well. So this is talking about when life has other plans, and that was my cute little title for insurance. So I think insurance is probably one of the most misunderstood things out here. This is not going to be a deep dive, just kind of skimming the surface on insurance to help people understand what's possible. And as you go through your life, you may run into different situations where you think, hey, this makes sense. And then you can go and explore whether one of these ideas can make a lot of sense for you. But the three primary purposes that I see for insurance are: 1, creating wealth; 2, protecting wealth that's already been created; and 3, transferring wealth. So I've got a picture here of a dad and a little daughter. And the first one is just talking about creating wealth. And this is something that, I've got insurance. I help usually parents with this type of insurance. And this is life insurance or living benefits insurance. What it does is it protects people against the situation where there's some sort of a loss, where if there had been no loss, the wealth would have been created. And this can be, it can be a parent. Obviously, that's one of the biggest use cases that we see. You have a plan to earn your income over the next however many years. If something happens and you die unexpectedly, your ability to earn goes to zero, right? So what insurance does is it fills that gap. You buy it, you pay some sort of a monthly or annual premium, and if you should die, then the insurance company has a contract and they say, okay, you've been paying your $100 a month or whatever. I'm very sorry that you died. We've pooled your money with a bunch of other people. Here's your $300,000 or here's your $5 million or whatever it was. So that's wealth that just gets created instantly, basically upon death of somebody. Now, there are a couple other kinds. There's disability insurance. So you're intending to work, you're intending to make all this money and save it and do everything with your life. Something happens to you. Like I was just up at this cottage, there was an older gentleman, but he was on some cliffs overlooking the lake, taking in a beautiful view. He was on some sort of a rotten log or something, slipped down, fell down onto some rocks and was just crushed and in a body cast for, I think, 3 months or like something absolutely terrible. And sadly, in my business, you hear about all the bad stuff that happens to people. So someone in his situation, if he had disability insurance, that would kick in and then he'd get a check every month. Depends on how the contract is set up. And then there's also illness insurance. So, so the illness insurance would just be if somebody gets sick. There's this big list that an insurance company says, okay, if you get cancer, you have a heart attack or stroke or all these different things, if one of those things should come into your life, you get some sort of a payout, and it can help to, deal with the fallout from becoming sick. So the next one is about protecting wealth. Now, a lot of people work extremely hard and are very diligent for a long time, and they build up a fair bit of wealth, and then different things can erode it very fast. Taxes is one of those things that I've talked about a little bit. So making sure that you're aware in advance of what the tax liability of your family situation is going to be. And some people say, okay, we've identified that, someone's on the hook, whether it's the family cottage, like in this example, we bought it, Grandpa Joe bought it back in the 1950s for $25,000. The cottage down the lake just sold for $800,000. That means there's a, $700,000-$800,000 gain there. Somebody's going to have to pay that when it transitions between generations. So you could buy insurance to offset that. Otherwise, who's got a couple $100,000 lying around? A lot of people don't. And then that's why people get forced to sell family businesses, family investments, family cottages, different things like that. Another use of this type of permanent life is to be able to provide liquidity to an estate that has illiquid assets. So somebody may have a bunch of real estate properties. I talked to somebody earlier this week who had about $5 million in real estate properties, but they've got no cash flow other than a little bit of rent trickling in. But a lot of these are development properties. So they're worth so much money, but they've got no actual cash, and that can put them into a desperate situation. So with insurance, you could buy something that says, okay, upon the death of this, the older mother or the father or something, the estate gets $100,000 and then they can just do everything that they need to do. So it is a very specialized thing. I'm not trying to presume any of this makes sense for anybody, but I've just seen that there's so many misconceptions. I just wanted to explain a little bit about how some of it works. And then this one is also talking about protecting wealth. So with living benefits insurance, this is money that will be provided during somebody's lifetime. And I talked a little bit about disability already, having that kind of supplemental income that people can have coming into their life. critical illness, somebody gets sick, there are a lot of new expenses. You may miss work. Even just parking at a hospital can be a burden for some people if you have to go for tests like 6 times a week. It's insane. Long-term care is another one. To be able to have dignity and live in some way that you want to live for your entire life, that's something that some people like. Basically, long-term care says, okay, you know what? You pay this certain amount of money to an insurance company, and they guarantee for the rest of your life, they'll make sure that you've got X amount of dollars coming in every month. So that can provide huge peace of mind. One thing I've been kind of surprised by over the last couple of years, and it's only women, but a few of them have said this, older women, typically that have net worths into the millions of dollars, like I'm talking 3, 4, 5, $8 million, afraid that they're going to be eating cat food someday, which I'm always astonished by. And I'm always like, no, like that, I can't even imagine what would have to happen for that to be possible. But people are worried about that. So some of this stuff is just to help generate peace of mind. Annuities are another thing that can generate income for life. And then segregated funds are another type of insurance, and they offer some guarantees. Sometimes they'll have income guarantees. Sometimes they'll have guarantees that if the market just plunges, there's a certain amount of value that will be protected. So these are just some of the things out there that could be worth learning more about if you find yourself in one of these situations at some point during your lifetime. So the last kind of use case, the third one is when you're going to be passing your wealth on, and permanent insurance is another thing for that. And I didn't explain this up front, but life insurance is kind of like renting a car. Permanent insurance is kind of like buying the car. So life insurance, you're kind of paying your way as you go and you can cancel anytime. Permanent insurance is more, the insurance company says, this is how much you have to pay every year for a certain number of years, and then you've got this and it's set for the rest of your life. So it's a lot more expensive. You don't get as much coverage dollar per dollar that you're putting in up front, but for some people, it makes a heck of a lot of sense. So tax planning is probably the number one way that we would use this. This is people who have a business or a corporation or maybe a cottage or something like that. It can help create lifetime income. It can help to leave a legacy. Say that you are worried about running out and spending all your money, and you say, no, there's an animal hospital, and I really want to make sure that when I die, they get $100,000 or some big chunk of money. Some people will buy an insurance contract, pay it up, and then it's a guarantee, and that's taken care of no matter what happens to them. It's kind of set and forget. And that is very similar, I would say, to philanthropy. And there's some tax advantages sometimes to using this. So some of you, may be earning a ton of money in the future. You may start huge businesses. I'm not sure. And these things could be things that you'll have to give some serious thought to. And then finally, intergenerational wealth. So transitioning money to the next generation. So just peering into the future, I'm just doing kind of a light version of this because there's been a lot of information in this, but I just want to show you when I'm working with somebody, kind of what we're looking at. So I made up this hypothetical person, Lisa, who's, composite of some different clients that I have. Said that she's a 35-year-old healthcare professional. She owns a condo in downtown Toronto, and it's worth $850,000. She paid just under $600,000 for it a few years ago. Her mortgage balance is about $475,000 at 3.09%. She's probably going to refinance it soon at a lower rate because that's what's been happening. She's doing, earning some pretty good money, total compensation of about $165,000 a year. She's got an RRSP and she socked away $120,000. She's got a locked-in retirement account from a previous place where she worked, $72,000, and a TFSA with $30,000. So this is kind of what people often, on an almost daily basis, I have someone being like, here you go, and I just want to show you kind of what goes on in their head, and then a little, like 2 seconds into what I do with it, and no other pensions, for the record. So these are some of her questions. Am I doing everything that I should be doing? That's what people are wondering, at all stages in the game. Like, talk to somebody who's, typically people that I'm working with have some wealth to manage, or they plan on having a lot of wealth to manage. So this stuff is relevant for them, but they may be well into their career and very strong earnings, but they're not sure. Maybe they had somebody that they worked with that retired or just kind of faded to the sidelines. I kind of see that happening. And they're just not sure. They kind of want like a tune-up or a check-in. Another one, am I on track for financial freedom? Because, if I said, put your hand up if you want to retire and sit on a beach until you die someday, probably no one is going to do that, on this call or most of the people I talk to. But people love the idea of having financial freedom where they don't need to work anymore. They've got enough passive income from investments and other sources in their life where they can just do whatever they want, whether it's travel or consult or, keep working in some capacity. Do my investments look right? Is there a way to save on taxes? Should I get a will? Probably everybody should is my answer. Do I have the right types of insurance? What if I'm an executor? So these are just things that I'm seeing over and over. These are questions that people are asking out there. RBC has been doing a ton of work for people that are executors because what we see is that there's a huge transition going on. A lot of people have grandparents and older relatives that are, from their 70s up to just over 100, and that generation's slowly, moving on, and everything's trickling down to the next couple of generations, and people are getting named things like executor, and some people are inheriting pretty significant assets, and they're not always sure what to do. So it's helping people navigate all of this. So I just put one slide here. This is a report that I love doing for people. I do a lot of these with people, and it just helps to visualize everything. And it helps to put everything into perspective and to answer those questions mathematically. Like, they aren't all mathematical. If somebody says, how can I leave a better legacy? I'm not talking about money. That's a whole different question, getting into things like, well, what kind of family meetings can we be having, and having those types of conversations. So, I think whatever you do, whether you do something, work with someone like myself, or you do it all by yourself, or whatever it is, having some sort of a plan that you operate from will probably be the best way to get optimal results over your lifetime. My final slide is just a shameless plug for my industry, but just talking about how people who use advisors and get advice, typically, the stats say, do much better over time. So households that are using advisors and using advice, whether it's an advisor or, maybe an accountant, I don't know. I see a lot of accountants kind of merging a little bit into the advisory world, and a lot of them are fantastic. But just like I kind of draw a line, I say, look, you got to talk to an accountant about that. I think that there's great stuff that they both do. But basically, over 15 years, people typically, a family will generate about 4 times the wealth, or hold on to about 4 times the wealth if they're out there getting advice from people. So with that, I came pretty close to the end of the call, but that was my last slide. So